Welcome to the boom and bust signal, where we try to fill the gap between Wall Street and Main Street. The beginning of May 2023, we were looking and analyzing strategies to hedge an S&P 500 equity portfolio. We had monitored the volatility on the S&P for several months, and on May 1st, it had dropped at around 15%. If you look at this graph, since COVID started, each time the volatility fell below 20%, in the following weeks, then it bounced back up to levels of 40 and 50%. So 15% was an entry level, a cheap way to hedge your portfolio. We also looked at seasonality. Most of our options trades were sent in the months of September, which usually in the past 50 years is the worst performing months for the S&P. But nevertheless, we decided to analyze this trade in May because of the big fall of the volatility to 15.5% on the S&P. So if you look at this table, you see how the S&P performed in the past 50 years, and you can see how September was one of the worst performing months. Looking at our trade analysis, we looked at two strike, 4,000 and 4,050. We picked the 4,000. It was a very cheap way to buy protection, only $13. And just a few days later, the same strike went from $13 to 40. This is about 200% performance in just a couple of days. Other trades that we did in the past, in the month of September, because usually September is more volatile, we also purchased out of the money puts for about $20. And they went as high as $150 in just a couple of weeks. That means a return of about 700%.